station. Badu, and I'm a licensed certified public accountant in the state of Illinois. I'm the owner and practitioner of my firm, Badu Tax Services, and we specialize in tax preparation, tax planning, and tax representation for individuals and businesses. So today, really, the topic of discussion, I'll be talking about one of the most unknown ways to invest your retirement funds. It's definitely great to save for retirement, but a lot of people don't know about the strategy known as the self-directed individual retirement account. But before we go into that, I would like to kick it off with a market report. So this report is as of October 13, 2017, so as of last Friday. So each of the benchmark indexes essentially posted a gain by last week's end, except for the Russell 2000, which fell 0.5%. The large caps of the Dow and S&P 500 enjoyed moderate increases, as did the global Dow, which gained the most last week. Most impressively, the NASDAQ ended the week at a new all-time record. As a matter of fact, as of this week, as of today, the NASDAQ actually hit 23,000 points, which is the highest it's ever been. So the market has been doing really hot this year. We've had a really great year. But essentially, so equities marginally increased in value, and investors favor gold and long-term bonds, which both saw price increases. And then the price of crude oil went up from $49.25 per barrel to $51.37. And the price of COMEX gold went up from $12.78.90 to $13.05.60. So essentially everything went up in the market. And so far this year, the Dow Jones is up 15.73%. NASDAQ is up 22.71%, so almost 23%. S&P 500 is up 14.04%. Russell 2000 is up 10.72%. And the global Dow is up 16.92%. So overall, we've had a really great year. This has probably been the best year I've seen in a very long time in the stock market. So today, really talking about one of the more unknown ways to save for retirement. It's something that you will probably never hear unless you're in the financial industry, unless you're a real estate investor, or unless you have some sort of specialized knowledge about just money and investing in general. And that is known as a self-directed IRA, or self-directed retirement account. So there are plenty of ways to build wealth. In this world, there are many ways that we can go out and get money. We can build wealth over time. But most of the wealthy actually utilize retirement accounts in order to build wealth. So they don't necessarily invest the way that most of us do, where we might open a brokerage account or a stock account or something like that. And so what some people do is they actually utilize things like the Roth IRA account, and they invest that money instead in order to gain tax benefits. And so some of the most well-known individuals that we have out here today actually invest through retirement accounts, or they've built a tremendous amount of wealth tax-free, basically, through retirement accounts. So what retirement accounts allow us to do is to build wealth either on a tax-deferred basis or sometimes even on a tax-free basis, such as a Roth IRA. Now, we know that taxes can have a significant impact on your wealth. So ultimately, taxes, the average American, they say, pays 40% in taxes. And so if you don't have the proper tax strategies, if you're continuously working for money, instead of being on the other side, then taxes can really have a huge impact on you. So the problem is that most people don't know that they can invest virtually anything, or they have unlimited investment options when it comes to retirement accounts. Some people think that you can only buy stocks, bonds, mutual funds, the typical or the usual. But the truth is that you can actually buy virtually anything with your retirement account. And the problem is, here's the big problem, is the people that we look to for advice, or some of our financial advisors, they won't promote something like this because they don't get paid if they sell this, they can't sell it ultimately. Most of these brokers don't actually offer it, so there's no way to get paid a commission when somebody has a self-directed IRA account. And so that's one thing to keep in mind, is that this is what I'm about to present is so powerful that most people don't even know about it, because it's not something that's actively promoted in the world that we live in or in today's day and age. And so let's talk about the self-directed IRA. And when I say IRA, it's individual retirement account, but it actually applies to any type of retirement account. It can apply to a 401k, for basically 457, 407. I mean, it can get pretty crazy. 403b, 457, 4, all the different 4s in the world. The tax code is pretty complicated and came out with all of these retirement plans, but it can apply to IRAs, 401ks, even health savings accounts. All these different, and a health savings account really isn't a retirement account, but a lot of people, including myself, actually treat it as a retirement account. And so there's a tool out there known as the self-directed IRA that allows you to invest in virtually anything, such as real estate. A lot of savvy real estate investors, and I actually work with a lot of my clients are real estate investors. And so what they do is they actually self-direct their retirement accounts. So they have control over their money, and they can choose to invest it however way you want to. You can buy Super Bowl tickets with your retirement account. You can buy gold. You can buy land. You can buy anything in the world you want. There's a few exceptions which I'll go over later on in the presentation. But basically, you can buy anything you want with your retirement account, because remember, it's your money. You should have control over it. And so let's say you want to buy some real estate. So different transactions include buy and hold rental properties, some fix and flips. You have some tax liens or some tax deeds or some auctions. Subject twos, where you take over somebody's mortgage. Seller financing, where the seller will actually give you the mortgage. And so all these different transactions, your IRA can also be involved with it. And so a self-directed IRA, the basic definition is it's an IRA that can buy anything that's permitted by law or by the tax code. So the benefits of investing with an IRA are the tax benefits and the amount of protection that your account has. So your IRA or retirement account actually has bankruptcy protection. So if somebody was to ever sue you and win in a judgment, a lawsuit, or anything, they couldn't even come close to your retirement account, because it's protected, it's protected by law, basically. So nobody can ever gain access. It's a shield. It's a rock. It's very solid. Nobody can ever touch it. And this includes IRAs, 401ks, pensions, and all the different retirement accounts that are out there. Virtually nobody can touch them. So that's a very huge advantage when you invest through retirement accounts, on top of the tax advantages that you receive. So it's practically a no-brainer. And even your health savings account, and if you have a 401k, can also be self-directed. So can you imagine your health savings account, something that you use for healthcare expenses, owning a piece of real estate? To me, that's pretty powerful. And so in order to do the strategy, in order to get into the strategy, the first thing you have to do is to find a self-directed IRA custodian. There's a company that I personally use called Equity Trust. And so once you find that custodian, once you've identified that custodian, you then have to either roll over the money to the custodian, or you basically have to make a new contribution. And remember, IRAs have a $5,500 annual contribution limit, or at least traditional and Roth IRAs have a $5,500 annual contribution limit. If you have a SEP IRA, it's up to $54,000. If you have a 401k, it's up to $18,000, not including the match. And so all these different accounts, let's say you lump them all together, and you call all of these custodians or brokers up and say, hey, I want to roll over my money. It's time for me to actually take control of it. And so I want to self-direct my IRA. And so once you gather all of that money, you hand it over to the custodian, and it's known as a rollover. It can either be a direct rollover, a 60-day rollover. the best way to do it is what's known as a trustee-to-trustee rollover. And so where your company or those companies actually directly contact a company like Equity Trust, and they hand the money directly to them instead of handing it to you first, which can be a pretty dangerous situation. And so once you hand them this money, they will allow you to do what's known as self-directing, meaning that you now can take the money and actually invest it into real estate, into anything you want. So imagine a separate bank account now that you have access to that can invest in anything you want instead of just the traditional stocks and mutual funds and things like that. And so a custodian can be either a bank, a credit union, or a trust company. Most self-directed IRA custodians are actually trust companies. So Equity Trust, for example, is a trust company. And so your IRA now becomes a separate legal entity, per se. Doesn't necessarily have a tax ID or anything like that. But your IRA, imagine your IRA now becoming another human being, or becoming another bank or so, that you have access to it now. And so so let's say you've done all of these things, you're ready to go, you have the money in there, you're ready to self-direct. Let's say now you want to buy some rental properties, which is an excellent strategy, by the way. Now, the problem with buying rental properties in a retirement account or in an IRA is that you don't get the benefit of what's known as depreciation. So when you buy a property, a residential real estate property, you actually get to depreciate over 27 and a half useful life. So each and every year you get to take a certain amount of depreciation. Now, when you're in an IRA, your IRA belongs really nowhere on your tax return, so there's no way to depreciate that property. So the depreciation gets basically trapped into your IRA where you can't deduct it. So when you self-direct and you own a rental property, just keep in mind that you do not get the benefit of that depreciation. But I mean, you're gaining tax benefits anyway. Your rental income is not taxable, where it's tax deferred. Your appreciation on the property is non-taxable. So when you sell the property, it's either tax deferred or tax free. And most of the time, your property will appreciate, even though you should not rely on that when you're investing. You should be relying on the income or the cash flow that's associated with the properties. And so a lot of people, or a lot of savvy real estate investors, they actually self-direct their retirement accounts. And remember, this can apply to health savings accounts, 401ks, IRAs, any of those different accounts. And then, so 90% of self-directed IRAs are actually funded from rollovers. So most people aren't just handing new money, quote unquote, to these custodians. They're actually rolling over from a retirement account that maybe they're not too happy with. Maybe it's sitting in a mutual fund that's eating up about 3% fees per year. Something like that, of that sort, we don't necessarily want. And then keep in mind that you can actually roll over. So here are a few little rules, nothing too heavy to really get to know about, but you can roll over money from your current employer's 401k to a self-directed IRA or 401k if you're over the age of 59 and a half. Most employers do not allow you to do this if you're under the age of 59 and a half. But some will allow you if you are age 55 and older, or most will allow you to do that. And then you're only permitted to do one 60-day rollover per every 12 months. So if you're not doing a trustee-to-trustee transfer, if you're the middleman, basically, you can only do this once. Now, of course, some people strategize. They get savvy with this. You have 60 days from the time that the custodian hands you the money to hand over to another custodian. So guess what some people can do? This is not recommended, but you can potentially do a very short-term flip. Maybe you're doing a very, very short-term fix and flip, for example. You acquired a property, or maybe you're buying something that you absolutely need. Maybe an emergency came up. So you have 60 days to basically recoup that money and hand it over to the custodian, or you'll get taxed. You'll get hit with the penalty. So it's highly not recommended to do something like this, but just keep in mind that you have the option to take advantage of the 60-day rollover, because you have 60 days to hand the money over to the other custodian, the self-directed IRA custodian. And so that's just something to keep in mind. And so I would highly recommend that you do a trustee to trustee rollover just to avoid that situation from ever happening. And so retirement accounts or self-directed retirement accounts cannot own things such as collectibles. And collectibles include art, stamps, just different things like that. You can't own life insurance, even though some people just own outside of retirement accounts. It's technically still a quote-unquote retirement account, such as a whole life insurance, permanent life insurance. I would say most people that have these accounts actually use them for retirement purposes. But your IRA cannot directly buy a life insurance policy. You also cannot own S corporation stock. It's just one of those rules out there. So you would have to own either a C corporation or an LLC, or any investment that basically constitutes a prohibited transaction according to the tax code, such as the purchase of an investment from a disqualified person, including your spouse, including the spouse of the retirement account holder. So you can't transact with your spouse. Your IRA basically cannot buy your spouse a car. They're just different things like that. And so here's another twist, is that your IRA can actually own an LLC. So not a Microsoft or not a big LLC, but your own LLC. So you can actually form a new LLC and have your IRA be an owner of it, and you can buy properties that way, which is highly recommended. You cannot buy a personal residence with this, because then it wouldn't be an investment. It would be a personal property. You can't self deal or self transact with yourself with your retirement accounts, and you cannot rent out property from your IRA. So if your IRA owns an LLC, it cannot rent out property to your daughter or to your son or to yourself or anything. So there are prohibited things that a lot of people like to take advantage of the tax code, including myself. So these are some of the things that we cannot do because they're illegal. So we cannot rent out properties from our IRAs to our family members because they're prohibited. And so ultimately you cannot transact. And I'll explain the definition of what I mean by transact in a second. But you cannot transact an IRA with the IRA owner and also certain family members. And by transact, I mean buy and sell. I mean lease, exchange, loan, extension of credit, provide services, goods. Anything really that requires you to take money out of the account or put money into the account, you cannot be, or your family members cannot be, a party to that transaction. Now, you can own a portion of the LLC. Let's say you become a 1% manager of the LLC. You could do that because ultimately you need to be involved in that LLC. But just know that you cannot be one of the parties directly in that transaction. So the IRA has to buy the piece of real estate directly with the seller. The IRA cannot loan you money to buy real estate with a seller. The IRA has to pay the seller directly for that property. So just keep in mind, you cannot self-deal, you cannot transact with yourself in the IRA account because people would take advantage of it. So just something to keep in mind. And then a prohibited transaction, what ends up happening is that you're going to pay taxes at your marginal tax rate. And then also you're going to pay a penalty on the distribution. So let's say you're working on a fix and flip project. Let's say it requires a $100,000 investment to buy the property. And let's say it takes about $30,000 to put in work, fix it, and everything like that. And you have $150,000 in your IRA account. But for some reason, some way, somehow, you ended up being a contractor in that transaction. So you transferred money from your IRA to yourself as the contractor, which is a prohibited transaction. And so whatever gains came out of that transaction is now prohibited. So let's say you sell the property for $250,000 and you have a Roth IRA, and it was a self-directed Roth IRA. It owned an LLC that bought this property, and you happen to be the contractor or the general contractor. You paid yourself basically, which is a prohibited transaction. Now that $250,000, so let's see, $130,000 total acquisition price, $250,000 sales price. Let's throw in some closing costs and things like that in there. Let's just say $20,000 to make the numbers even. So let's say you have $100,000 profit. Well, since you've self-directed or since you've self-dealed or you've had a prohibited transaction, now you have to pay taxes on that $100,000. And so that's what I mean by a prohibited transaction. You cannot be one of the parties directly to the transaction. Now, you can be controlling everything, or you can be the one that's, maneuvering things, but you cannot receive money directly from the self-directed IRA. You would have to pay a seller, a third-party construction company, which cannot be your sister. It cannot be your son, your daughter, your dad, your mom, or anything like that. It has to be somebody outside your family, basically. So it gets a little bit complicated. And the reason for this is that you would just end up abusing the code, basically. And so just know that you cannot self-deal with your retirement account. And a disqualified person essentially is anybody that's related to you. So the IRA owner themselves, the spouse, the children, the spouses of the children, the parents, grandparents, grandchildren, and their spouses, any company that you own 50% or more by you or a family member or anybody that's prohibited. Also, any 10% or more partners or shareholders in a company that you own 50% or more. And then, so these are really all the different people that you cannot transact with. You can't buy and sell real estate with these people. Now, you can partner with them. There's a difference. Their IRA and your IRA can actually, there's a rule with that. So I would say whatever you do not involve these people with your retirement account. So if you're doing a partnership or if you're going to partner on a real estate transaction, you can use your IRA, but find somebody that's a third party, and then your IRA, so their IRA's third party IRA with your IRA can form a joint venture, own an LLC, and then buy a piece of real estate. That's perfectly fine. So just don't buy it with your niece, nephew, or anything like that. And so the weird part is actually your brothers and sisters are not included in this prohibited transaction list, which is kind of crazy. But so your brother's IRA or your sister's IRA, you can actually transact with them, so they can own a piece of the real estate, or you can actually hire them as a contractor, and it wouldn't be considered prohibited. So it's just one of those crazy things with the tax code is that your brothers and sisters are not prohibited people to do transactions with. And the other things you cannot do is you cannot personally guarantee loans. So you cannot go out and get a mortgage. Your IRA cannot go out and get a mortgage, and the bank tells you have to back it up or personally guarantee it. And this also applies to anybody that's disqualified. And also the loan has to be what's known as a non-recourse loan. So if the property, let's say something goes bad, if the deal goes wrong, the bank cannot take possession of your IRA because of the whole bankruptcy protection. And so the bank would simply have to foreclose on it, and nothing ends up on your credit score because your IRA does not have a credit score. Now, the LLC that the IRA owns might be affected, but you yourself, you have nothing to lose, basically. And then also, of course, you cannot loan money to yourself in an IRA. That's known as self-dealing. In a 401k, though, you could if the employer allows it. And then keep in mind that if you're a business owner, you can have as many 401ks as you want. So you don't have to be an employee in order to have a 401k account. If you own 5 businesses, you can have multiple 401ks. And so if you start a business, you're making a lot of money, you can set up a 401k plan, put that $18,000 amount in there. Of course, you have to match yourself, or you don't have to, but you probably want to match yourself. So it's a little bit more than that $18,000. And so ultimately, you can have just a large pool of money through retirement. And back then they say one of the presidential candidates, he ended up with $20 million in his retirement accounts, basically, just because he was a strategist. He was savvy. And so what he was doing was, instead of him investing his money outside of retirement accounts, he invested money within his retirement accounts. So that's pretty powerful right there, and basically tax-free money. So imagine having $20 million of tax-free money in your retirement account right now, and by the time you retire, or even before, you can actually utilize certain aspects of the tax code where you can receive distributions early, tax-free, and penalty-free. So these are more advanced strategies that I won't really get into, but just know that it's an option. So with an IRA, remember, it can own an LLC. An IRA, once you have it or once it becomes self-directed, it basically becomes another human being or another entity. And the IRA can own the LLC 100%. It can own a 99%, 50%, however way you want to structure it. And then so your IRA can partner with somebody else's IRA, and then those two IRAs or those 3 or 4 IRAs can own the LLC together. And if you're running real estate or doing rental properties, it's best to hire a third-party management company, because if you become the manager, if you're collecting a salary, well, guess what? That's a prohibited transaction. And then you can also lend out money to people with your IRA. So you can become what's known as a hard money lender, where you charge points and interest, or you can become a private money lender, where you only charge interest. And so if you do attach a mortgage, or if you do end up loaning money to somebody on a real estate, let's say fix and flip, it's best to secure a deed of trust / the mortgage and a promissory note. Anytime you're lending money, you always want to have that protection, always want to attach. So really that's really it as far as self-directed IRAs. It's a very, 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 very powerful strategy account to use. A lot of people, probably I would say maybe more than 90% of Americans, don't know about this, that you can actually self-direct your own retirement account. You don't have to stick to the stocks, bonds, mutual funds. You can buy real estate. You can buy Super Bowl tickets. You can buy World Series tickets. You can buy, you can bet on horse races. You can do anything really with your self-directed IRA. And so there are plenty of ways to build wealth ultimately. And investing through retirement accounts is an excellent tax advantage strategy to use if you truly want to build wealth. Because remember, if you're using things outside of retirement accounts, you might face some tax implications. If you're doing fix and flips and you make, let's say you're netting $50,000 on these properties on average, well, you're going to have to pay short-term capital gains taxes, because these are probably short-term properties. And so short-term capital gains taxes are taxed at ordinary taxes. So whatever your tax rate is now, that's what would be applied. And the highest ordinary income tax rate is 40% or 39.6%. And then you have state taxes. Illinois is close to 5%. And so imagine 45%. Let's say you're in the highest tax bracket and you're doing fix and flips all the time. Well, 45%, imagine paying 45% in taxes. So let's just say 50% of your profits are gone. Had you been doing this in a retirement account, though, basically up to, let's say, as little as 0%, you can pay as little as 0% in taxes if you invest in retirement accounts instead. And so really that's really it as far as the presentation. If you have any questions about the strategy, please give me a call. 773-679-7198. You can find me on social media, on my website, jeffbadu.com. I post a lot of these different strategies, these different tools and techniques. These are some of the things that the well-known billionaires that we know use today, and they're actually available to us as well. We just have to gain access to it. But that's really it for the presentation. So thank you all for tuning in to WGHC 98.3 FM, your voice, your music, your station. My name is Jeff Badu once again, and I thank you all for tuning in. And I look forward to continuously delivering you all some content on personal finance. And so, thank you.
And now, from the Windy City to the world, this is WGHC 98.3 FM, Chicago's #1 African music station.